The big daily headline which has sent jitters all around has been the fall of the rupee against the US dollar. So what does this fall of more than 10% against the US dollar in this calendar year mean for India's real estate sector? The residential or housing market was just seeing some recovery in sales and new launches. Will that get derailed? And how about long-term foreign inflows into other arms of real estate which have been holding up very well, like the commercial office space, warehousing and logistics business? Let's find out from my two guests today. Anshul Jain, Country Head and Managing Director, India, Cushman & Wakefield. Also with us, Vinam Srivastav, CEO, India Operations and Private Funds at Ascenda Singbridge. Gentlemen, thank you very much for joining me. I think, Mr. Srivastav, I'm going to come to you first. How do you view the weakening of the rupee right now for long-term investments? I mean, has it affected your sentiments or your India view at all?
Yeah, hi Manisha. Yes, the slide of the rupee has actually been challenging to the real estate sector overall. And if you see, it's being driven by key global factors, not domestic. Oil price increase, with increasing demand for the dollar. There's rise in the U.S. Bond yields, so that's attracting investors to U.S. treasuries. And at the same time, the trade wars driven by U.S. and China is actually resulting in a flight of dollar from emerging economies. So what all of that is actually doing to the real estate sector are essentially impacting it in three ways. One is it's resulting in inflation. So you see, a weakening rupee combined with the increase in oil price is a double whammy, because India imports roughly 80% of its oil demand. What that does is results in increase in transportation costs and therefore inflation. Now, inflation for a real estate developer and operator like us results in increase of construction material cost, iron, steel, cement, wages, architects, engineers, all those input costs increases for us, right?
Right.
Even import of technology and equipment increases, and it could also result in delays in project timelines. So that's one, as a developer. As an investor, then what that does is, in order for inflation to be controlled, it's quite likely that interest rates will go up. And real estate, like any capital-intensive sector, is driven by debt, right? So in a high interest rate scenario, our cost of funding increases. Now, once our cost of funding increases, that puts pressure on the yield spreads that developers and investors in real estate can afford. What it also does is that actually increases the capitalization rates, and therefore the valuations of assets becomes a bit softer.
Correct.
So that's the danger of operating in a higher interest rate environment. And the third impact that it does is actually directly reduces your dollar rate of returns or foreign currency rate of returns, and effectively the distribution of dividends in the hands of our foreign investors. So because of all of these three things, the impact on real estate is quite direct and at times significant, and that could sometimes actually scare investors and result in a bit of a slowdown in the sector.
Okay, fair enough. Anshul, quite a pity, isn't it? I mean, you had the beginning of 2018 seeing that big open window for FDI to come into construction, including affordable housing and real estate, and now you have the rupee risk, which is pretty evident, and like we've just heard, Vinam, not an easy one to look away from. What do you see that? How do you assess the situation? Was it that there was a good amount of acceleration of foreign capital into real estate, and now that's going to get hampered?
Look, I mean, first of all, I'd like to say that, you know, I mean, the rupee depreciation over long run is a given thing, given the difference in the inflation between various countries, and given our status as an emerging economy and what's happening in our economy versus what's happening in the global economy. So in my view, I think if investors are taking a long-term view on India, a rupee depreciation of 2 to 3% per annum is probably expected, or should be expected, and should be priced into any investment decision. We've seen this is not the first time that the rupee is depreciated sharply. I mean, the last bit was between 2009, or I'd say between 2010 and 2013, rupee held its ground, in fact appreciated against what it should have done. And then 2014, if you remember, just driven by current account deficit at the time, rupee plummeted sharply. But if you event it over a period of time, the difference was maybe if had rupee depreciated 3 to 4% per annum, it would have been similar. And I think we're seeing a similar situation right now. because rupee had actually stabilized at 67, 68, and then in fact appreciated to 63, 64 rupees, despite the difference in the interest rate, and somewhat aided by the fact that the oil prices were all-time low.
So am I hearing that there's nothing to be concerned about, Anshul? Is that the position you're taking?
Yeah, what I'm saying is that, you know, at these levels, and we heard the finance minister today saying that, you know, it's probably going to settle back at perhaps more reasonable levels. And then if you look at the difference between 67 rupees, which was where the rupee was for most part of the last few years, and perhaps a 70 odd rupees, the difference is about 4 or 5%. All the factors that Vinamra just laid out still stand true, and I don't dispute that. But I think in any long-term business implication, these factors have to be priced in. There is a short-term problem, which I'm sure the industry will take some time to adjust.
Okay.
But at these levels, unless the rupee goes by another 5 or 10%, I don't see a big issue hitting us in the near future.
Okay. All right. Vinod, my question to you now is that, look, I mean, if you look at real estate portfolio globally, Asia, especially India, is where money was flowing in, expecting better yields, because, I mean, other parts of the world yields are quite compressed in this business. If you were to price in the rupee risk today, do you think that, you know, you would put a stop to some of your investments that you thought of, or do you think that right now the situation is not that dire?
I think, Manisha, I do agree with what Anshul mentioned. We are a long-term investor in India. Ascendas has been operating here for more than 25 years. And for investors like us who are in the country for the long term, we actually price this in the investments that we make. If you average out rupee depreciation of the last 20 years, that comes to around 5% per annum roughly. And we take measures. We already underwrite assuming that depreciation. We actually hedge as well, quite scientifically, to make sure that we are protecting our downside. So I think this does not really impact long-term investors who are in the country for good, because they already protect themselves through all these mechanisms. The other positive spin to this is actually for commercial investors and developers like us. This is resulting in actually boosting the export sector. So a lot of our customers are actually IT services companies that are driven by exports of services. Now, the rupee depreciation is actually a good thing for them. So the dollar value that they are generating per square feet of space that they are occupying is actually increasing. So there's a bit of a counterbalance. And at the same time, for investors like us, the very fact that the GDP growth is still fairly robust and it's being driven by organic demand and the fundamental strength of the economy, those are positive points. So, so I think, yes, this is a short-term challenge that the industry will face. But if you are in it for the long run, then you should be comfortable. All
right. Very quick reaction then. What I'm hearing is that Finance Minister is trying to assure everybody, and we shouldn't get panicky about the rupee's fall right now. Anshul, you're with that? The resilience of the Indian economy continues to stay, and foreign money, especially in long-term projects, will continue to come through?
I absolutely. I think institutional investors don't shy away because of one economic event. It takes a lot for institutional investors to shy away. But what will really happen is, you know, perhaps the residential sector may get hit depending on what happens to the interest rates. If interest rates in India rise up sharply, and that has a resultant effect on mortgage rates, then unfortunately the residential sector may just have another quarter of slowdown before the end user buyers start getting adjusted to sort of new mortgage rates. But I think from an institutional basis, from a foreign domestic FDI inflow into real estate in India, personally, I don't see any challenge.
All right. Okay. Vinam Srivastav and Anshul Jain, thank you, gentlemen, for running us through what your impressions are of that weakness in the rupee. So long term, no concerns yet, but short terms, yes, if interest rates go up, then the residential sector will take much longer to stage a comeback. Thank you so much for joining me on Urban Reality. Goodbye.